I just had a meeting with my financial people this week, and we were discussing what we have in Bitcoin versus everything else, and they actually felt that my ratio was exactly right. So,
like, what is the ratio?
Based on what?
Based on how they view people should be diversified in various things.
Okay, BlackRock said the optimal allocation for Bitcoin, and they said this in 2022 is 85%.
Where did this come from? BlackRock, the world's largest asset manager, has recently made waves after its groundbreaking recommendation for an 85% Bitcoin allocation in investment portfolios was recently shared and spread across Twitter and other social media. Although this research wasn't actually published in April 2022, it was only widely noticed recently. This move signifies a significant shift in the traditional financial world's perception of Web3, particularly Bitcoin. Okay, what are we citing here? 2.3, the effect of skewness in practice. We perform the following asset allocation exercise. Suppose we start with a 60-40 equity bond portfolio fitted to the moments reported in data in Exhibit 1. We compute the power utility risk aversion coefficient to yield that 60-40 allocation. In this case, a risk aversion of y equals 1.5 corresponds to 60-40. Then we hold the risk aversion fixed and estimate the optimal weight of Bitcoin. Assuming that the equity and bond weights are held in the same pro rata 60-40 allocation, that is, the equity and bond weights are set to be 1 minus this bullshit, 1 minus this bullshit, okay. Respectively, we use the mixture of normals distribution, see equation 1 and Exhibit 3 for Bitcoin returns, that captures large positive skewness. Exhibit 4 presents the results, starting with a 60-40 equity bond portfolio, which is produced with a risk aversion of y equals 1.5. The optimal Bitcoin allocation is a large 84.9%. The remainder of the portfolio, 15.1%, is split 60-40 between equities and bonds. Although Bitcoin has an extremely large volatility of 1.322, see Exhibit 1, the pronounced positive skewness leads to large allocations and dominates in the utility function, see equation 9. The certainty equivalent compensation required to not invest in Bitcoin is close to 200%. And Exhibit 4, starting at a 20/80 stock bond portfolio, leads to a 12.5% Bitcoin allocation, and a risk-tolerant investor with an 80/20 stock bond portfolio desires a levered position in Bitcoin of 106.6%. I'm so curious what this paper is from. This is page 10 of, what I'm curious about is I'm curious if this is like demonstrating the faultiness of some types of like risk aversion formulas because, well, look, if we follow this formula, I'm so curious what this paper is from. Actually, we can find this. Effect of skewness in practice. Bitcoin investments are positively skewed, and on average, they've returned 150% per year. With skewness meaning if we were to draw the expected whatever returns, it's going to be fatter on the right side of the middle than the left side. Positive skewness with a third central moment of approximately 150% per year. They are well characterized by a mixture of normals distribution with one normal regime and a small probability of a bliss regime where the price appreciation is more than 100 times at the annual horizon. The large right tail skew induces investors who prefer positive skewness to add significant Bitcoin holdings to equity bond portfolios. Even when Bitcoin is forecasted to lose half its value in the normal regime, investors with power utility optimally add 3% allocations to Bitcoin when the probability of the bliss regime is around 1%. Cumulative prospect theory investors are even more sensitive to positive skewness. They hold Bitcoin allocations of about 3% when the probability of the bliss regime is 0.0006, and the mean of Bitcoin in the normal regime corresponds to a loss of 90%. Okay, so the key findings of this paper, it is optimal to hold a small allocation to Bitcoin. I'm not going to speak for all of academia and all of research, but oftentimes when you see a thing that looks fucking retarded, the thing itself is not usually retarded. What's retarded is how it's being cited. For instance, when these guys are saying, there was a paper that said that you should hold...
in various things.
Okay, BlackRock said the optimal allocation for Bitcoin, and they said this in 2022 is 85%.
That's retarded. That's probably not what this paper is saying. My guess is going to be, and this is too much for me. Like, this is past my area of comfort in saying I can even truly comprehend what this paper is saying. But it sounds like this paper is just going through different types of risk assessments that you can use, and then it's analyzing Bitcoin through different formulas. And I'm sure the author of the paper understands the limitations of these formulas and understands the specific point in time. And it's just talking about like, well, if you risk analyze this way, like you could argue these crazy things. When he said in the paper, and we even saw this in the quote, right? Exhibit 4 presents the results starting with a 60-40 equity bond portfolio, which is produced with a risk aversion of y equals 1.5. The optimal Bitcoin allocation is a large 84.9%! Exclamation mark! He knows that that's a crazy finding, right? BlackRock's rational. So this is not BlackRock. Anybody saying this should just be criminally charged for being either criminally retarded or just lying. This is not a BlackRock recommendation or a BlackRock rationale or whatever. They literally say at the end of this article, not that it matters, I guess, same thing for me, hedging doesn't matter. The views expressed here are those of the authors alone and not of BlackRock. Not of BlackRock, but okay. The report suggests not only should institutional investors consider Bitcoin, but retail investors have also shown a growing interest, reaching an all-time high. The shift in sentiment from large banking institutions and funds, which were once critical of Bitcoin, underscores the cryptocurrency's growing acceptance and potential for mainstream adoption. It sounds like this paper, from the very little I understand of this, okay, it sounds like what this paper was about was running Bitcoin through different risk assessment models and then finding out what would the appropriate allocation of Bitcoin be, assuming some things to be true, and then like what would we expect to see a portfolio done if the investors were like aware of all these things. That's what the paper was exploring, basically. Not making a recommendation or doing like a huge analysis of the performance of Bitcoin versus other assets or whatever. Just like, so that was 30 minutes to understand how fucking crazy that statement was. I wonder what they say afterwards. And before they say, oh, that wasn't actually, then they correct for all of it. And I just wasted my time doing this.
Exactly right. So, you know,
Based on what?
based on how they view people should be diversified in various things.
Okay, BlackRock said the optimal allocation for Bitcoin, and they said this in 2022, is 85%.
BlackRock said that your Bitcoin allocation should be 85% of your assets?
Yes.
For the like the retail investor?
As the ideal portfolio should be 85%. This was in 2022.
How much Bitcoin does BlackRock have?
Yeah,
Could be quite a bit.
Yeah,
But
if it's 85% of their portfolio,
rationale was
They don't even cite the actual paper. They're citing Morgan Creek Digital, Alternative Thinking About Investments. And they have the same paragraph here. Is this even a real thing? Morgan Creek Digital, 85%. Imagine doing all this work to write these papers and then fucking dipshits quote you like this. Welcome to Morgan Creek's Digital Asset Update. It is comprised of a thought piece from our team. We hope you find this content interesting. Morgan Creek Digital analyzes BlackRock's study that suggested an 85% Bitcoin allocation. As with many sensational headlines, though, this suggestion and excerpt were taken out of context. The 85% allocation was assuming a certain portfolio construction. So these, so this sounds like these guys are real finance people. Wait, so he's posting a link to the thing that's saying that he's misquoting it. This suggestion and excerpt were taken out of context. Was it intentional that they cut off the bottom of this, or was this just all they could fit on the page? The 85% allocation was assuming a certain portfolio construction, risk aversion factor, and model approach, none of which BlackRock suggested were the optimal assumptions or concluded approach to use. In the following sentences of the same paragraph, allocations of 12.5% and 106.6% levered are the resulting outcomes under different conditions. Jesus Christ. Okay, sorry. Fuck me, dude.
Percentage of assets?
Yes.
For the like the retail investor?
As the ideal portfolio should be 85%. This was in 2022.
How much Bitcoin does BlackRock have?
Yeah,
Could be quite a bit.
Yeah,
But
if it's 85% of their portfolio,
rationale was that it was such an asymmetric.
Like, do you know what the assets under management of BlackRock is? Like, you think that BlackRock has trillions of dollars? What is the total market cap? Like the fact, like nobody here even has in their brain like any type of approximate understanding of any. Like, imagine if you were to say like, oh, the U.S. federal government. Like, how much money do you think the U.S. government spends on? How much money do you think the U.S. government spends on trans rights? On trans rights, I don't know. If I had to guess, probably like $1 trillion. Like, how can you be that many orders of magnitude off on a guess there? $1 trillion, over half of our discretionary spending? Or like, imagine like we need to make huge cuts to the federal budget. Really? What's like a huge cut you would make? Oh, like I would cut like $10 million from this shit. It's like 10 million. The discretionary spending is like 1.7 trillion. That's not a huge cut at all. Like to have nothing in your head about like the approximate like costs or values or numbers, like what is this? How could we like that? What an unbelievably crazy, stupid statement. Like, oh, maybe BlackRock has 80% of their holdings.
BlackRock have?
Yeah,
Could be quite a bit.
Yeah,
But
if it's 85% of their portfolio,
rationale was that it was such an asymmetric risk to take for the amount of upside. Like the amount of upside you
that's
take
interesting.
for the amount of downside was so strong that it should be 85% of your portfolio
Right,
to
so I guess-
maintain the proper allocation of like risk versus reward.
right, because
It sounds like he's either read an article about this that was wrong, or he read a little bit about that and just doesn't understand what's being said,